What up, future billionaires and current ramen noodle enthusiasts? Your favorite slightly cynical financial analyst is back, and today, we're cutting through the BS that financial influencers peddle faster than a crypto bro shilling an NFT of a pixelated rock. Everyone wants to be the next Wolf of Wall Street, timing the market, hitting that 1000% gain on a random meme stock, and flexing a lifestyle they probably can't afford. But what if I told you the real secret to generational wealth, the kind that doesn't require selling your soul or your sanity, is actually incredibly boring? Yeah, I know, buzzkill. But stick around, because in this 11-minute masterclass, we're doing a full vibe check on the ultimate financial showdown, the quiet, consistent power of index funds versus the loud, flashy, and frankly, often broke, hype of individual stock picking. Let's get real. The allure of stock picking is powerful. It feeds into our main character syndrome. We scroll through TikTok and see some randos talking about their diamond hands and how they aped into some hot new tech stock that's going to the moon. Everyone wants to feel like they've got that special insight, that secret sauce, that they're smarter than the market. It's the thrill of the chase, the dopamine hit of a green candle, the fantasy of telling your boss to shove it. And guess what? Wall Street loves this narrative. They want you day trading, churning your account, paying those sweet transaction fees. They want you subscribed to their premium newsletters, buying their exclusive stock picks, attending their unmissable webinars. It's an ecosystem designed to extract value from your hope and your FOMO. But let me drop a truth bomb that most won't. For 99.9% of us, individual stock picking is less about strategy and more about gambling. You're essentially buying a lottery ticket, hoping it's the next Tesla or Amazon, while statistically, it's far more likely to be the next Blockbuster. Ouch. And before you come at me with your "but my cousin's friend made bank on Dogecoin" stories, let's talk about the cold, hard data. Every year, S&P Dow Jones Indices releases their SPIVA report, S&P Index versus Active, and it's basically a graveyard for active fund managers' egos. Year after year, the vast majority of actively managed funds, run by experts with entire teams of analysts, billions of dollars, and access to insane data, fail to beat a simple benchmark like the S&P 500. We're talking over 85% of large-cap funds failing to outperform over a 10-year period. Over 90% over a 15-year period. Let that sink in. If the pros, whose literal job it is to beat the market, can't consistently do it, what makes you, a retail investor scrolling Reddit at 2 a.m., think you can? It's not a lack of intelligence, it's a fundamental reality of market efficiency, information asymmetry, and the sheer cost of trying. Think about it, by the time you hear about a hot stock, every institutional investor, every hedge fund, every algorithm with supercomputer processing power has already digested that information, traded on it, and priced it into the stock. You're always late to the party. Plus, every trade you make incurs costs, commissions, bid-ask spreads, and eventually, taxes on your short-term gains. These tiny leaks become massive holes in your returns over time. Your emotions are also a giant liability. FOMO leads you to buy high, panic leads you to sell low. It's a vicious cycle that actively sabotages your wealth-building efforts. So, if stock picking is a rigged game for most of us, what's the alternative? How do you actually build wealth without being a financial genius or a trust fund baby? Enter the underdog, index funds. What are index funds? Imagine a giant basket. Instead of painstakingly picking individual apples, hoping to find the perfect one, an index fund just buys all the apples in the entire orchard. Or at least, a representative slice. Specifically, an index fund is a type of mutual fund or exchange-traded fund, ETF, that holds a diversified portfolio of assets designed to passively track the performance of a specific market index. Think the S&P 500, which holds the 500 largest U.S. companies. Or the total stock market index, which holds thousands of U.S. stocks. When you invest in an S&P 500 index fund, you're not just buying Apple, you're buying Apple, Microsoft, Amazon, Google, Tesla, Nvidia, Johnson & Johnson, Coca-Cola, you get the picture. You own a tiny slice of the biggest, most successful companies in America. You're not trying to beat the market, you are the market. And historically, the market, despite its ups and downs, always goes up over the long term. It's like magic, but it's just economics and human innovation. Now, let's talk about the unsexy superpowers of index funds, because this is where the quiet wealth strategy truly crushes the stock-picking circus. First, diversification on autopilot. This is massive. Instead of putting all your eggs in one volatile basket and praying that one stock doesn't tank, an index fund spreads your investment across hundreds, if not thousands, of companies. If one company stumbles, your overall portfolio barely notices. You don't need to predict the winners, you just bet on the entire economy. It's the ultimate risk reduction strategy, built right in, no effort required from you. You own the entire damn race, not just one horse. Second, and this is a silent killer for active investors, low fees, massive impact. Actively managed funds often charge expense ratios of 1% or more annually. That might sound tiny, but it's a leak that compounds over decades. If you have $100,000 invested, that's $1,000 every single year, whether the fund performs well or not. An S&P 500 index fund, like Vanguard's VOO or iShares IVV, often has an expense ratio of around 0.03% to 0.09%. We're talking pennies. Over 30 years, that 1% difference isn't just a fee, it's your potential Lamborghini fund. It's hundreds of thousands of dollars that stay in your pocket, compounding and growing for you, not for some fund manager's bonus. Those basis points are literally the difference between a comfortable retirement and having to work longer than you want. Third, the magic of time and compounding. Index funds aren't about getting rich quick, they're about getting rich reliably. By consistently investing over decades and letting your returns generate more returns, that's compounding. For the uninitiated, you unleash an exponential growth engine. The boring part is the secret sauce. You set it, forget it, and let time and the market do the heavy lifting. This isn't a race, it's a marathon, and the tortoise consistently wins. Your biggest edge as a retail investor isn't your stock-picking prowess, it's your time horizon and your ability to do nothing. Fourth, and this is crucial for the emotionally volatile creatures we are, emotional bypass. Index funds remove the single biggest impediment to your financial success, yourself. No more checking your phone every 5 minutes, agonizing over stock fluctuations, panicking during market dips, or getting overly confident during rallies. You automate your investments, and you detach. You learn to embrace the dips as buying opportunities, knowing that over the long run, the market recovers. This emotional detachment isn't just good for your portfolio, it's good for your mental health. No more doom scrolling your brokerage account. And let's be real, even the smart money secret weapon, Warren Buffett, a literal legend, has explicitly recommended that most people, including his own family, should invest in a low-cost S&P 500 index fund. If the Oracle of Omaha says it's the way, who are we to argue? It's not about being smarter than everyone else, it's about being smart enough to know what you don't know, and then leveraging the collective intelligence of the entire market. Now, I know some of you are thinking, but what if I can pick a winner? What if my hot stock tip is different? Look, the probability of you consistently picking individual stocks that outperform the broad market, after fees and taxes, over a long period, is statistically similar to winning the lottery multiple times. You might get lucky once. You might even have a good year or two. But can you repeat it? Can you keep that edge for 10, 20, 30 years? Almost certainly not. It's survivor bias. We only hear about the few who made it big, never the thousands who crashed and burned. So, yes, it's boring. And that's precisely its strength. Wealth building should be boring. It shouldn't be a TikTok trend. It shouldn't be a casino. It should be a consistent, predictable journey. Does this mean you can never buy an individual stock? If you want to, sure. But treat it like a hobby, not your core wealth strategy. Dedicate a tiny percentage of your portfolio, like 5%, to fun money for individual stocks or even speculative ventures. And be prepared to lose it all. Consider it entertainment, not investment. But for your actual retirement, your long-term goals, your "don't want to be poor when I'm old" fund, stick to the boring stuff. That's where the real wealth is built. So, for all you chronically online Gen Zers ready to actually build wealth, here's the no BS how-to. It's embarrassingly simple. First, open an investment account. Fidelity, Schwab, Vanguard, M1 Finance, they're all solid. Do some research, pick one that vibes with you. Second, identify a broad market index ETF. My go-tos are VOO, Vanguard S&P 500 ETF, or IVV, iShares Core S&P 500 ETF, for large-cap U.S. exposure, or VTI, Vanguard Total Stock Market ETF, if you want literally every publicly traded U.S. company. If you want international exposure, VT, Vanguard Total World Stock ETF, is your one-stop shop. Third, set up automated investments. This is key. Decide how much you can contribute from each paycheck, $50, $100, $500, whatever you can afford, and set it to automatically buy more shares on a regular schedule. This is called dollar cost averaging, and it takes all the emotion out of it. You buy when prices are high, and you buy when prices are low, smoothing out your average purchase price over time. If that still feels like too much, consider a robo-advisor like Betterment or Wealthfront. They literally do all of this for you, for a slightly higher but still reasonable fee. Look, I get it. The idea of slow and steady isn't as sexy as to the moon. But while everyone else is chasing ephemeral trends, getting burned, and stressing themselves out, you'll be quietly building a fortress of wealth. You'll be leveraging time, compounding, and the unstoppable engine of human progress. You'll be free from the constant anxiety of market timing. You'll be the one chilling in 20 years, while the stock-picking gurus are still trying to sell the next hot tip on TikTok. Stop trying to be a trading guru and start actually building wealth. It's time to choose consistency over hype, facts over feelings, and long-term peace over short-term thrills. You got this. Now go hit that like button, subscribe for more brutal financial honesty, and drop a comment below telling me your boring investing strategy. Peace out.